Good day, students. This is Professor Alexander Buchholz coming to you for our chapter today on accounting for not-for-profit organizations. So, a few learning objectives that we want to take a look at this day is as follows. Describe the source of accounting standards for non-government, non-business organizations. Identify the three basic statements for not-for-profits. Describe the basic funds used by non-government, non-business organizations. Distinguish between a current restricted fund and an unrestricted fund. Explain the term assets whose use is limited. Distinguish between a mandatory and a non-mandatory transfer. Explain how contributions are recorded by not-for-profit organizations. Understand how donated services are recorded. Describe the funds used to account for property, plant, and equipment. Explain the basic accounting used by endowment funds. Indicate how equity investments are reported in the financial statements. Explain the change in accounting for loan funds brought about by new standards. Understand the use of an annuity or life income fund, and discuss the special reporting issues of hospitals. So, we basically have four major classifications of not-for-profit organizations, and not-for-profit organizations, for a lot of you, could be a career choice. A lot of people go into not-for-profits, not just as auditors, but they go into it as controllers, as CFOs. Why? They like the missions of these organizations. They like the ability to have flexibility with their schedule. So again, those of you that may want to work for a not-for-profit, a lot of times they don't work crazy hours. Doesn't mean they work easier, but it's not as strenuous perhaps as maybe working for an IBM or a Microsoft, to name some of the larger corporations. So several types of not-for-profit organizations that you're going to take a look at would really be as follows. The nonprofit institutions of higher education. So again, we're talking here about a private school, not the City University of New York. Please don't consider that to be a nonprofit for a, that's really part of the overall city and gets consolidated a little bit differently. So a St. John's University, a Mercy College, that would be of higher education, that would fall under the scope of this particular chapter that we're talking about today. Hospitals and other healthcare providers, they also are considered to be not-for-profit. Does it mean that we cannot have a for-profit hospital, a for-profit nursing home? Yes, they do exist. A little more difficult and far less common, but they are around. Okay, so definitely be aware of that. It does exist. Voluntary health and welfare organizations, those companies who basically are supported by contributions, possibly government grants, and other non-government, non-business organizations, daycare center, charter school. So again, what we have over here is we have our own not-for-profit accounting standards. So we basically have a hierarchy, and that hierarchy does fall within the FASB jurisdiction. So it is not GASB, it is FASB, Financial Accounting Standards Board. Okay, and it is found in the codification, the FASB standards, ASC 958. That's where we go for all the guidance related to not-for-profit and healthcare. You have three basic statements when you're doing a financial statement. So the first one is the statement of financial position. Again, in our for-profit world, we know that is the balance sheet. And we've got three types of categories. Now, these three types of categories are very important for a not-for-profit. So they have three buckets. The first one is unrestricted net assets. So if somebody gives an organization money and does not tell them what to do with that money, it's considered unrestricted. Un meaning no restrictions. If somebody gives them money and basically says that these are temporarily restricted net assets, meaning that the assets have to be used for a specific purpose or in a specified time period, meaning I give a school $1 million and I tell the school that this $1 million will be spent on giving scholarships for accounting students. That is a temporarily restricted donation, falls within temporarily restricted net assets. Again, the school can only use it for a specific purpose. Permanently restricted net assets, sometimes you may have heard them as endowments. Again, I give you $1 million, but I tell you, you cannot spend the $1 million. Only the earnings from the $1 million. That is considered an endowment. Permanently restricted net asset. You can never ever use the corpus. You can only use the earnings. The second statement is a statement of activities, what you would know as an income statement. The third, the statement of cash flows. So again, we do not have the concept of other comprehensive income in not-for-profit reporting. Some, but not all not-for-profits, please note that, some but not all, use fund accounting. Not a lot of them do, but some do, depending on the organization. So the 6 common funds we've seen in the not-for-profit world is the current fund, which is your restricted and unrestricted net assets. Your plant fund, which is exactly as it sounds. It houses your property, plant, and equipment. The endowment fund, loan fund, where we give out loans, agency or custodial fund, and annuity and life income, which we're going to learn about today. So again, depending on the organization, and again, I do not-for-profits as an auditor, I see some of these funds being used in the schools. And again, this is older mentality. Not a lot of people are doing these anymore. In order to be part of the accrual basis of accounting, which not-for-profits are, they are the accrual basis. So again, revenues are reported when earned and realized. Expenditures are reported when the materials or services are received. Expenses incurred before the reporting date are accrued, and expenses related to future periods are deferred. No different than the 4 profits we've been learning about. For external reporting purposes, revenues are classified by source, and expenses and expenditures are classified by function or activity. So the current unrestricted funds. So financial resources that may be spent at the discretion of the board. As we said, unrestricted, no restrictions. Whereas current restricted funds, those are restricted because of legal, contractual, or external restrictions. Accounting for board-designated funds. So it's part of the current unrestricted fund, and the resources are designed by governing board for specific purposes, projects, or investments. It aids in the planning and control of expenditures and limit discretion of management. Governing board can reverse or modify designations. So again, sometimes we may have a board, and the board will designate internal money for whatever purpose it is. Please note, it is a board-designated fund. It is not restricted. Only a donor can restrict money, not the board. Assets whose use is limited, AWOL, as we sometimes refer to it, are used in hospitals and or nursing homes, and these are assets set aside by the governing board, again, for board-designated purposes. Also, it could be set aside as potentially to satisfy debt requirements. So we have a a bond which is going to be paid off, serial bond, in several installments. And the bond requirements tell you to keep an assets whose use is limited account. Cannot touch that money. It is designated for a specific purpose, again, to pay off those bonds. So it's still part of the current fund. It's not a donor restriction, but it must be treated and handled accordingly for the purposes of bookkeeping. Colleges and universities. Board-designated funds for specific current operating purposes are accounted for by footnote or by reclassification of the unrestricted current fund balance. Some board-restricted current resources can be transferred to other funds as well. Mandatory and non-mandatory transfers. Mandatory transfer. So a transfer from current funds to other fund groups. That could be due to legal obligations, a grant. Non-mandatory is discretionary. The governing board wishes to transfer money from board designated to another current fund. Again, they're allowed to do that. It's within their rights. It's a non-mandatory transfer. Most not-for-profits, how are they supported? By contributions. Many times you may receive a phone call or a letter in the mail asking you to donate for a specific cause, maybe donating to a foundation. Why? Because that's how a not-for-profit survives. Similar to the normal revenue recognition, we recognize revenue in the period in which it was earned. So again, that could be an unconditional promise to give, meaning a pledge. So I pledge $1 million to the Lehman College Fund Foundation. That would be recorded in the current period as a receivable, pledge receivable, and as a credit to revenue. Contributions can be cash, pledges, donating services. We volunteer our services and get nothing. We're going to see that the FASB has a special accounting for that type of work. Gifts of non-cash assets, fixed assets. I'm going to donate my equipment, my computer equipment. That is a donation. Conditional promises. Conditional promises are a little bit different. If we want to think of it as deferred revenue, it's a good way of looking at it. I give you $1 million. However, the $1 million can only be recognized if you raise $300,000 in addition to my $1 million. So if you raise the $300,000, the $1 million is yours. But if you don't, you need to return that money to me. That's called a conditional promise. And at that point, the asset stays as a deferred revenue on the books of the particular organization because they're not entitled to that money as of yet. Pledges. So pledges are recorded as revenues when a promise to give is non-revocable and unconditional, and it's usually at present value. So if I have a pledge which is going to be given over 20 years, we've got to discount that to today's dollar. And pledges are signed commitments to contribute specific amounts of money to an organization on a future date or in installments. And although resembling promissory notes, usually pledges are not enforceable contracts. It's not enforceable. They really can't take you to court over it. But again, normally if somebody's giving a pledge, it's expected that they would give it. If, however, you do have people that do not fulfill their pledges, Well, then you should establish an allowance for uncollectible pledges. So let's take a look at an exercise here. We have a well-known celebrity-sponsored telethon for a foundation. Pledges are $1 million. Using similar telethon campaigns, we estimate 25% will be uncollectible. During 2016, 700,000 of the pledges were collected. The remainder were uncollectible. So let's identify the funds and prepare some journal entries here. So these are current unrestricted funds. We're going to debit the pledge receivable for $1 million and credit revenue from contributions. In the next entry, we're going to record an expense provision for uncollectible pledges of $250,000 and credit allowance for uncollectible pledges. In 2016, we'll debit the cash for $700,000 and credit pledges receivable. The balance that we're writing off is a debit to expense for provision for uncollectible pledges for $50,000, writing off the allowance of $250,000 and the remaining pledges of $300,000. So if we were to look at the T account, all your pledges in 2016 should end up as a zero. Donated services. As we said, a lot of times a not-for-profit will receive donated services, but the FASB has made a specific requirement that you can only recognize these donated services under certain parameters being met. Number one, it enhances or creates a non-financial asset. That's number one. Or requires special skills provided by individuals possessing those skills and would need to be purchased if not provided. So if I was to volunteer my services to a not-for-profit as a chief financial officer, again, and not get paid, that would be recognized as an in-kind. Why? Special services being provided by myself as a CPA, and if they didn't have me, they'd have to hire somebody. So that would be recorded as revenue or support with an equal amount being shown as an expense. Now the question is, well, Buckholz, how did you decide what amount to record on the books? And what they'd have to do is look online to see what a normal CFO salary would go for. That amount would then obviously have to be recorded on the books and records. In the second example, during 2015, volunteer pinstripers, these are the people that normally go up and down with newspapers and candy, donated the services to the hospital at no cost. The staff at the General Hospital was in control of the duties. If regular employees had provided the services by the volunteers, the salaries would have been $6,000. While working for the hospital, the pinstripers received complimentary meals from the cafeteria, which normally would have cost $500. Required: prepare the journal entry necessary in the general fund to record the donated services. We would debit general services expense for $5,500 and credit donated services non-operating revenue for $5,500. Again, we took the $6,000, but we also took away the meals that we would have given them. Why are we recording this? Well, basically it's a service that was needed and we would have had to have paid for it, which is why we would record it. The other thing to note is, so if I record an expense, $5,500, revenue of donated for $5,500, you'll notice that this has a zero effect on the P&L. Why then should we be recording this, is what many of you should be saying, and the answer to that is simple. We need to still show the reader of the financial that this is something that the organization is purchasing. They're purchasing it as an in-kind expense and receiving it as revenue. So if the organization would have had to have gone out and buy these particular services, this would have been $5,500 of an additional expense and $5,500 out of pocket. Donor-imposed restricted contributions. So as we said before, I can give a donation. Doesn't have to be unrestricted. It can have imposed restrictions. And it usually is recorded as a contribution revenue in the period received, which would increase either temp or permanently restricted net assets. When expenditures are made, or the restriction does expire, your net assets get what's called released from temporarily restricted net assets, and it's reported as unrestricted on the statement of activities. Meaning, once the expiration of my donation has expired, it goes from temporarily restricted net assets to unrestricted net assets. Think of it as a reclass of retained earnings, to kind of give you an analogy to the for-profit world. In this example, Exercise 3, the Franklin Public Library received a restricted contribution of $300,000 in 2015. The donor specified that the money must be used to acquire books of poetry written in the 16th century, so again, temporarily restricted. As of December 31st, 2015, only $100,000 of the restricted resources had been expended. Let's prepare the journal entries necessary to record these events during 2015. Let's also indicate the fund where it goes. So hopefully a lot of you have already said, yes, this would be a restricted current fund. And we're going to debit cash for $300,000, credit contribution revenue for poetry collection. That's entry number 1. Entry number 2, technically, is all the way down here. We bought the books. Let's debit expenses for poetry and credit cash for $100,000. Once you do that, the FASB now says, here's entry number 3. Debit the net assets released from restriction, which is kind of like an equity transfer of $100, and credit cash. And you're going to give that cash to the unrestricted current fund. And you're going to credit net assets released from restriction. Again, equity transfer. So keep in mind, if it's an equity transfer coming out here, an equity transfer going in here, at the end of the day, there's a zero impact to the statement of financial position. But we still need to record it as such. The plant fund. A lot of not-for-profit organizations use a plant fund. And that really is going to show you what your fixed assets are. It's also going to account for the accumulation of accumulated depreciation expense, acquiring and disposing, any liabilities. So if I have a mortgage on a building that I did want to acquire, it's going to go in the plant fund. When we get into colleges and sometimes university, they may divide their books into self-balancing subgroups where they'll show it as unexpended plant fund, funds for renewal and replacements, meaning that colleges will put away money because they know they're going to have to replace buildings, dorm rooms, so they set aside money, funds for retirement of indebtedness, which is debt, and investment in plants. So again, they'll have different plant funds for this. Exercise 8. After the election of a prominent political figure, the principal from a term endowment fund was expendable by Crandall University. The official was elected this year. The fund was restricted to the construction of Political Science Building Annex. The following occurred because of this event. Let's look at the journal entries and identify the funds. So, A transfer of $3 million is made from the endowment fund term to the unexpended plant fund. So again, we release the fund, endowment fund balance, $3 million, and credit cash. In the unexpended plant fund, we debit cash and credit the fund balance for $3 million. Construction is then begun on the political science annex. The costs of construction during the year amount to $1 million, of which $30,000 is unpaid. In this particular university, the controller does not does not record transfers to the investment and plant group until it's done. So they debit unexpended plant fund for $1 million CIP, credit cash for $970, and credit accounts payable for $30,000. By the end of the following year, the annex is completed at an additional cost of $2,100,000. All costs have been paid. So, in the unexpended plant fund, we debit construction in process for $2,100,000, debit accounts payable for $30,000, and credit cash for $2,130,000. We now debit the building for $3.1 million, and work in process is credited, or construction in progress is credited for the $3,000,001, because now we're transferring. We now do the fund balance restricted for $3 million and fund balance unrestricted for $100,000. Why? Because $100,000 is not coming from the endowment fund, it's coming from other resources. So the unexpended plant fund transfers the building of $3,000,001, and then it goes into the net investment in plant fund. Debit building, credit net investment in plant, like a fund balance. Hospitals also have a property, plant, and equipment, but they usually do it in the general fund. Contributed resources, restricted to acquire PP&E, are put into the plant replacement and expansion fund. Once they buy something, those assets are then transferred to the general fund. A voluntary health and welfare organization usually reports the plant balance in two classifications. Expended fund balance usually is the net investment. Gross assets less liabilities, which would be a mortgage, and accumulated. That's the expended fund balance. The unexpended fund balance represents the amount of resources available to require or replace additional PP&E. We then have endowment funds. Pure endowment fund is where it's been donated, given in perpetuity. A term endowment fund is where the donor gives you an endowment, but it tells you that after a certain length of time, the principal of that endowment can be expended. Income from endowment funds generally can be expended as earned for a specific purpose or at the discretion of the board. Who makes this decision? And hopefully a lot of you by now are saying the donor makes that decision, and you would be correct. The donor decides. So if they give you a $1 million endowment and it earns $10,000 in interest, the donor can say, I want you to spend that money for a specific purpose. If they don't, in the absence of them saying anything, it is automatically assumed to be unrestricted. And basically, you can imagine, what do you think many of your clients would want to have? They want to have endowment funds, which basically are going to give them earnings which are unrestricted. Let's look at the next exercise. Jefferson Hospital received money from a donor to set up an endowment fund. Let's do some journal entries. $2 million was received. The requirements were $100,000 of the income goes for research. The remainder is expendable under discretion of the board. The principal, however, can be expendable after the donor's death. It shall be used to purchase equipment. So in the endowment fund, we would credit cash of $2 million and credit revenue contribution restricted for $2 million. The cash received was invested in a number of securities. We'll debit investment and credit cash, and that's typical that we want the money to grow. Dividends and interest were received. So in the endowment fund, we'll debit cash of $400 and credit due to the general fund of $300,000. Due to specific purpose fund of $100,000. Because again, they did tell us that $100,000 is to be used for research. So the endowment fund would credit those amounts. The income is then transferred to the appropriate funds. The hospital is then notified of the donor's death. So they debit the transfer to plant replacement and expansion fund for $2 million and credit cash of $2 million. Accounting for investments. So in investments, when we're talking about them for not-for-profits, we do have to report them at fair value. And when we talk about fair value, we do have unrealized and realized gains and losses. Now, unlike the for-profit world, we do not have to worry about whether they go into income or comprehensive income. We don't have that here. Everything goes directly into the statement of activities. So please be aware of that in the not-for-profit world. There is no distinction. Sometimes in the colleges and universities, you'll see something called a loan fund. In the colleges and universities, we'll make loans to students and staff of colleges and universities. These are employees of hospitals that we could also make loan, and beneficiaries. So maybe loans to music students by symphony orchestra societies. Again, something where they're trying to enhance their quality and also get their name out there as a not-for-profit. So typically, if we look at this exercise, this is a loan fund for a university. $100,000 is received from an estate to establish a faculty and student loan fund. The interest rates go from 8 to 10%. Loans totaled $60, $40 was dispersed to faculty. And believe it or not, 10% is uncollectible. The third fact is that we write off $1,000 as uncollectible. Following loans are repaid: principal and interest. So first, $100,000 is received from an estate to establish a faculty and student loan fund. We debit cash in the loan fund and credit revenue contributions restricted. We then loan out loans receivable students of $60, loans receivable faculty of $40, cash out the door of $100. We then debit bad debt for the 10% of $100 bad debt expense, credit allowance for uncollectible students of $6,000, allowance for uncollectible faculty $4,000. We then write off a $1,000 student loan, debit allowance for uncollectible students for $1,000, credit loans receivable students for $1,000. The following loans were then repaid. So we debit cash for $16,300, which consists of loans receivable from students, $10,000, loans from the faculty of $5,000, and interest income from the two of $1,300. Some organizations also account for assets as an agency. Basically, what that means is to be a good example of a nursing home. People in a nursing home that aren't going anywhere usually have their assets looked after by the people who work in the nursing home. So typically, what they will do is record an asset and a liability. Because it's not their asset per se, they can't record it as revenue. So that's something that you need to be very, very cognizant of, because again, you'd record it as an asset and credit as a liability. And those two amounts should be the same. That could be true for a university that maybe holds money for students. That can be for a nursing home, could be a hospital. Anything with an agency transaction. The other funds that we'll typically see are annuity and life income funds. So again, a contribution to the organization could have a condition that the organization make annuity payments to a specified recipient for a period of time, maybe during their lifetime. So if it's a specified period of time, that's the annuity fund, or if it's during the recipient's lifetime, it's a life income fund. At the end of the annuity or on the death of the beneficiary, the unexpected assets can go either to endowment, loan, plant, or another fund. Some other issues that relate to the hospitals: recognition of service fee and operating versus non-operating income. When you're talking about healthcare, they look very carefully to see what truly is part of their mission versus what's not. A parking garage at a hospital is very convenient for the patients, but it does not necessarily have to do with the core of their operations. Therefore, that would be considered a non-operating revenue. So because it's a non-operating revenue at this point in time, that's why it would be shown usually in a different section of the statement of activities. Some other issues relating to hospitals: charity care. Sometimes, God forbid, somebody goes to a hospital in an emergency. They may not have insurance. That's called charity care, in that the hospital does not go after and record the receivable. What they basically do is they write off the receivable, reverse it like they never record the revenue, and just disclose it as charity care. Contractual allowances. Typically in a hospital, we may charge a certain dollar amount. Let's just choose the dollar amount, $1,000. However, the $1,000, ladies and gentlemen, may not be what the insurance is going to pay for. In the case where, let's say, the insurance will only pay $600, the remaining $400 is written off as a contractual allowance. Think of it like a contra revenue account. Capitation revenues. Certain insurances will pay $500, $1,000 a head, and the expectation is we give you this money per member. So if we give you $1,000 and it costs you $2,000 to care for the patient, that's not our problem. So that's something that, again, is called a capitation. Malpractice obviously is a big thing as well. That, again, they do have to carry insurance related to different claims. Presentation of bad debt on the statement of operations, again, is shown depending on if it's a hospital where there could be, that emergency situation where you're coming into the hospital, you do not have insurance, well, in that particular circumstance, you're basically going to record the bad debt as a reduction of revenue. If, however, you're in a situation where you can pick and choose your own type of when people are going to be admitted into your particular organization, well, at that point in time, you're allowed to record the bad debt as a normal operating expense. And that concludes our discussion on this particular chapter. We would encourage you to please go over it again before completing any and all assignments that you may have. Thank you, and please email with any questions. All the best.